Moving on, in this morning's Money Watch, the newest inflation numbers have just come out. They're starting to show the impact of falling gas prices. The Consumer Price Index shows prices rose 8.5% in July compared to a year ago. This follows June's inflation rate of 9.1%, which was the highest in more than 40 years. The national average of a price for a gallon of gas has fallen nearly 70 cents just over the past month. CBS News business analyst Jill Schlesinger is here to help us break this all down. Jill, good morning. 8.5%. That's a significant reduction.
Yeah, it may be that inflation peaked in the month of June because these July numbers are somewhat better than expected. Not fantastic news yet, but we were thinking 8.7% on an annualized basis. 8.5% is good. The other part of this report that as you mentioned, gas and energy prices, that pushes the numbers down pretty dramatically. And if we look at the gas index, for example, down 7.7% over the last month. Obviously, right? Since gas peaked in June, we're down $1 a gallon since then. But when you look at the year over year and you want to know why people are still complaining, that gas index is still up 44%. When we pull out gas and all energy as well as food, the rest of the inflation picture is still simmering. So we really have to pay attention to that, specifically shelter, which continues to be a big driver of inflation.
So how will we know that prices have peaked? I mean, what's the guarantee that they won't just go back up next month?
Well, I think that's a great question because the war in Ukraine is the real unknown. That was what pushed oil prices above $120 a barrel. Now we're back at 90. Food prices also increased because so much of the bread basket of Europe is derived from Ukraine. I think that if the war does not create another real shortage, that we could believe that over the next few months, we have seen the peak. The end of the year, we should come down towards 7, maybe 6%. But just remember, gang, before we started this inflationary period, the inflation rate in the United States was just under 2%. So these are big changes.
What does it mean for a potential recession?
Well, I mean, look, when we have high periods of inflation and the Federal Reserve is actively fighting that inflation by raising interest rates, those are the conditions that usually will lead to this broad slowdown called a recession. It does not appear we're in a recession right this moment. I mean, frankly, we had 500,000 jobs created in the last month, and an economy that can create 500,000 jobs is not usually one that is classically in a recession. So I think that maybe for another month, we're going to sort of put that recession talk off to the table.
500,000 jobs created, but on the flip side, unemployment is now at more than a 50-year low. Now, what does that mean when it comes to the inflation rate?
I'll tell you what's interesting about the story of the labor market, and that is wages. Wages have been going up at a pretty good clip, so 5.2% from a year ago. And businesses are saying we have to pay more, and that's hard. It's why it's hard to hire folks. But that wage component to me is very important because when you think about 5.2% of a wage gain, but inflation's at 8.5%, there's a gap.
There's that gap,
So people are falling behind.
Does this drop in the inflation rate mean that the Fed's interest rate hikes are working? And what does it mean for future hikes?
Well, I mean, yes and no. I think that it is clear that the Fed's rate hikes are probably having an impact on the overall economy. What's a bigger impact right now on these numbers has to be energy and food, and that's probably more war-related. So I think in the months ahead, the Fed is going to keep raising rates, and I think that they are going to have to because all those other items without food and energy are still high, and the Fed is probably going to go 1/2 or 3/4 next.
Jill, on our way out here, one last question. What is going on with credit card debt?
Well, you know, that gap that we talked about where someone's making, let's say, 5.2% more than last year, but everything costs 8.5% more this year. Well, guess what? First, people start spending down their savings. People had a lot of savings during COVID. There were stimulus checks. There was excess unemployment insurance. There was child tax credits. So they built up savings. They've spent those savings down. But now we know once those savings are down, credit card debt has increased.
Ballooned.
Credit card balances are up 13% from a year ago. That is the biggest annual pace in more than 2 decades.
Wow.
And just to be clear, who's borrowing the most? The people you would imagine. Young people. They don't have savings built up. And people who already have low credit scores. So we've got to keep an eye on that because as the economy does slow down, those folks are still going to be struggling with those credit card balances.
Wow. So it's not just you at home if you've got that credit card bill
No.
going up. All right, Jill Schlesinger, thank you very much. We appreciate it.